Hey folks, Jack Spirko here with another episode of Miyagi Mornings. We're going to have a little bit shorter of an episode. I got a lot of stuff going on today, and I found a question that I thought would be an interesting one for a lot of you guys out there that are trying to get your side hustle on and maybe, build up a little bit of online content. Content creation is a good business to be in. If you look at what I do since 2008, it's been my primary business is content creation. And it's a good business if you can make the commitment and be committed to it, and if you can make the frequency. So if you're going to podcast, weekly's minimum. If you're going to do video, weekly's minimum. I mean, weekly's minimum for anything, but daily is better. And if you're going to do something like 3 times a week, 4 times a week, whatever it is, once you make the commitment and meet it. And that's just a little extra advice today for you. The question's a little bit different, though. It's about taxes. I am very famous for saying that the tax code is 10% of what you have to do, and 90% of the tax code is how you get out of it. And that's the case. And there's a lot of things you can do when you run a business that you can't do when you don't run a business and you have a JOB. But that doesn't mean that it's magic. And the question today is interesting because it brings up a couple things. And that is, as a content creator, what can I deduct? And the person asking the question, again, on my MeWe profile, the very first post, it's locked at the top, is where you can suggest questions and topics for Miyagi Mornings. Basically said, I'm not making any money yet, but if I buy a thing for a video, can I deduct it? And it depends. So anybody that's a long-term listener to me knows I'm going to say CPA here. Like I always say tax attorney and CPA, but tax attorneys are more like business structure stuff. So when you're beyond a side hustle, when you're setting up an actual entity, this is when you really want to get into discussions with a tax attorney. CPAs can do 99% of what you'll need throughout running a business, and CPAs can do 100% of what most people will ever need. So the only thing you really need a CPA for here is, how do I do this? And do I do this? And is this okay? And if it's not, is there a way that I could make this thing deductible? And so I can't tell you what is or isn't deductible. There's so many things that transpond into this. There is the fact that some of you live in states with state income tax, I guess because you hate money. And so you might have actually different rules for your state income tax payments than from your federal tax payments. So I can't say exactly how this works. I'll just give you kind of a generalized understanding of this. So technically, if you're buying something to do a video or something like that, and it's not equipment for recording, like this microphone setup here or something like that. It is a item that you're going to review or use in a video or two or something like that. You're going to present it. Unless it's specifically for that purpose, it's not deductible. But who says if it's specifically for that purpose? And generally, again, things change. I haven't had my conversation with my CPA this year yet as to what we're doing, so I don't know anything that might have changed. Generally, items under $500 are pretty easy to just expense. Generally, please understand that. Generally, they're just easy to expense. Even if it's supposed to be depreciated, you can accelerate the full depreciation into a single expense. Not always. And the IRS is always on the lookout for what's called structuring. So if really like it was 4 things that are really one thing, but you parted out your purchases, that could work to keep each individual item under $500. But if, and it's a very long shot that most of you that earn, $100 grand or $200 grand a year or less are ever going to see an audit. Just understand that it's a low probability. But if it does occur, that's when those type of things come up. In other words, you can do it for years and years and years and never hear a word about it. But, you can end up getting some questions like, did you specifically part this out so that you could deduct it rather than depreciate it? Because some things, when they become an asset in the business, let's say go out and buy a computer to use, you would think, I'll just write that off. Well, no, now the business owns the computer. And the computer's value the day you buy it for, let's say, $2,000 is $2,000. And it's going to be depreciated over 5 years, let's say. And there's accelerated and standard depreciation. There's different models. Again, that's a CPA discussion. But let's say if we just did, let's say it was a $1,000 computer, and we depreciate it to 0 over 5 years, you would expense $200 the first year, $200 the second year, $200 the third. You get it until it's down to it's worthless, and then technically you're supposed to dispose of it somehow, which usually larger companies where they worry more about audits and stuff will then sell the item to an employee for $1, something like that. Even if whenever they decide to get rid of it, when it's like we're not going to use this anymore, they'll sell it for $1. So it's a transaction on the books, and then they can say, yeah, well, we took this thing to zero and we made $1. There's ways that maybe you can do that in a home-sized business, but it's probably not necessary. Again, this is a discussion with your CPA. Now, the person also said, do I have to make money first? It depends on how you mean what you're saying. In general, you have to have revenue. You have to have revenue. You don't have to make money means you're profitable, right? So if you have any income stream where you can say this revenue is tied to this activity, even if it's just a few bucks, then generally anything you do, as long as you're attempting to make a profit, right? And I'm serious about that. You have to be trying. You can write off. And you can generally do that. It's 4 or 5 years before you make a profit. You can do it. And then at some point, that revenue becomes taxable if you don't make a profit, because it becomes a hobby. It becomes hobby income because you're not actually running a going concern, is the way the government looks at it. Now, of course, you can always decide that you made a profit and then kind of reset things. Again, that's a CPA discussion. But in general, to safely deduct any expense from any activity, there should be some revenue there. Now, if you're doing videos, even if it's small, there should be some revenue from like Google ads, right? So you should be trying to make money is my point. And as long as there's a revenue stream, see, revenue and income are not the same. Revenue is how much money the business received. And if that business is a corporation or a sole proprietorship and you're doing business as, Bill Smith with your own Social Security registered with, Google AdWords, and you're getting money from them, that's revenue. Income, right, is profit. It's how much money you made. So if you have a revenue stream, you have the ability to deduct expenses against it. That's the way I understand it. Again, I'm not a CPA. I'm not a tax attorney. That's why I have those people who work for me. And what I generally do is, here's what I want to do. Will this be deductible? And if there is a way in which I need to do it, tell me what that is. And I will, and generally, been doing this so long now, I have pretty good instincts on it. I will bring every penny I've spent to my CPA when we do our annual, tax submission to the government and say, this is what I've done. What do I call it? That's generally the biggest thing. What do we call this? So that if we ever have to explain it, we're in the best position possible. And I just want to finish up today with something really, really important. Do not start a business just for tax deductions. That's not how this works. It is absolutely the case that as a business owner, you operate in a different world from an employee. As a business owner, I earn, I spend, and then I pay tax. As an employee, you earn, you pay tax, and then you spend. That is a life-changing thing as a business owner. I can deduct things that you can't even begin to think about deducting. I can deduct the space that I'm sitting in my house against the total cost of my house based on how much square footage this is relative to the rest. You can't do that if you're not in a business, okay? But I also earn a living from my business. I pay my bills with my business. I didn't set up a business just so I could do that. And if you do that, that's when you get into multiple forms of trouble. You get in trouble with the government maybe, but more importantly, you get in trouble with, you don't know why you're doing what you're doing, or the reason that is your why is not a good why, and you're going to make critical errors. There are rules to business and the way that you run a business to be fiscally responsible with the entity that you're operating, even if that fiscal responsibility only goes to one person, you. And when people come at this, I want a business so I can pay less taxes, right? That almost inevitably means that business will fail. You go to business to make money. You go to business to be successful in the business. And think of it like aquaponics, right? I know I make some weird analogies sometimes, but it's only because I see patterns. And the only reason that some people said yesterday, like my analogy was a stretch, that's because you've been trained not to see patterns. Our entire educational paradigm is built on making you not see patterns, because if you want to control people, you better make sure they don't see the patterns of control. All right? So in aquaponics, people always think, I want to do aquaponics to produce fish. No. You do aquaponics to produce vegetables. The fish are a byproduct, right? Anybody that's ever done it at any scale knows this. That you will never get a huge ROI from the fish, that you'll get this nice little extra bump of protein, but you're really running the system for production on vegetation. Anybody's done it commercially, they make their money on salad. I know people that have run aquaponics systems for years commercially, have never sold one fish. When the fish get to a certain size, they go ahead and they use them personally, and they'll let them get huge, because all they're worried about is they are the fertilizing component to the system, right? That's how you have to look at tax deductions in business. The purpose of the business is to make money. The byproduct is making money in a way where you give the government less of it. And that's the way to come at it, no matter what, content creation or otherwise. Anyway, hope you guys enjoyed that one. I will catch up with you tomorrow with another one.